Next reading is financial analysis technique. There are about 90 plus MCQs in this reading. First one, which of the following reasons is least likely a valid limitation of ratio analysis? First, moving in the reverse order, first, determining the target comparison value for a ratio is difficult. You can always find a comparator, A versus company B, or if you cannot find any comparator, you can take the industry average. This is not a valid limitation. It is difficult to find comparable industry ratios. Wrong. Industry averages are always available for the comparison purposes. Calculation of ratios involve large degree of subjectivity. Every ratio you will study in these questions, all are based upon numbers. All are quantitative measures. So this is not a valid limitation. Calculation of ratio involves large degree of subjectivity. No. There is no subjectivity in calculation of ratios. All the ratios that you will calculate involve numbers. And numbers are objective, not subjective. So that A is the least likely limitation of ratio analysis. So that makes A to be the correct option. And as you can see, A it is. A company must report separate financial information for any segment of their business. What is a business segment? Let's say a large organization, ABC Incorporated, may have separate divisions with their unique cash flows, with their unique assets, and their cash flows are distinct than the main operations of the business. So such segments, as per the US GAAP, are required to be reported separately. The requirement given in the standards is that segment, that division should account for more than 10% of the firm's assets. If the assets in segment A are more than 10% assets of the overall firm and its risk and returns characteristics distinguishable from the company's other lines of business, it's relatively self-contained, it has its own unique inflows and outflows, it has its own risk return profile, and it has assets more than 10% of the total assets of the firm, so it must be reported separately as a segment. This is the requirement of GAAP, Generally Accepted Accounting Principles in the US. So a company must report separate financial information for any segment of their business which accounts for more than 10% of the firm's assets, and risk and returns are unique to that particular segment. So that makes C to be the correct option, and as you can see, C it is. Now we have no computational questions, more computational questions and very few theoretical questions. Bentlom Company's common size financial statement show the following information. Current liabilities 20%, equity 45%. Bentlom's long-term debt to equity ratio is closest to. First of all, we need to analyze the information that is given. We have been given current liabilities in our common size financial statements. 20% of the total balance sheet. Equity 44% of the total balance sheet. It means these percentages have been given as a percentage of balance sheet total. Right? Now, taking these numbers first, we need to find out the debt to equity ratio. Debt to equity. How do you find debt? We know the basic accounting equation, assets is equal to liabilities plus equity. When you say liability, liability consists of current liabilities as well as long-term liabilities. Alright, what we need this debt specifically. Equity is given as 45%. If 45% of this represents equity, 20% represents current liability, it means the remaining is debt. So you can say that debt from this side of the equation, it is 100 less 45 for equity less 20% for current liabilities. What you get remaining is long-term debt. Now long-term debt, this part is what percentage of equity? Equity, as you can see, is 45%. So you can simply simplify this fraction. Total liabilities and equity is 100. Out of this 100, if we deduct equity and current liabilities, it gives you the long-term debt. Long-term debt as a percentage of equity, this is called debt to equity ratio. So if you simplify these all, it should be equal to 77.77%, which is approximately 78%. So that makes B to be the correct option, and B it is. Next, to calculate the cash ratio, the total cash and marketable securities. Cash ratio, the formula we use to calculate the cash ratio, it's equal to cash plus marketable securities upon current liabilities. So to calculate the cash ratio, the total cash and marketable securities is divided by what? Current liabilities. Simple description of the formula that makes B to be the correct option, and B it is. Here we go. The following footnote appeared in Crabtree Company's 2007 annual report. On December 31st, 2007, Crabtree recognized a restructuring charge of 20 million, of which 5 million was of severance pay for employees who will be terminated in 2008. And 15 million was for the land that became permanently impaired in 2007. Two events occurred. First, we restructured our business, reorganization cost. It was 20 million, and out of which 5 million was severance pay. This is a one-time charge. It has been paid in 2007. It is not expected to recur. It's a one-time charge, right? Next, there was a land impairment of $15 million. 15 million was for the land that became permanently impaired in 2007. These are the two changes that happened in 2007. Based only on these changes, Crabtree's net profit margin and fixed assets turnover in 2008 as compared to 2007. First of all, net profit margin is computed using this formula: net profit upon sales multiplied by 100. And assets turnover, fixed assets turnover, is equal to sales divided by average fixed assets. It includes land as well. Now, the important point to consider that this 20 million charge, including 5 million of severance pay, it was a one-time charge. It has already been written off. There will be no such charge in the current year. Resultantly, the net profit for the year 2008, it would be higher. Net profit as a percentage of sale would be higher, because the charge is no more recursive. It has only happened in 2007. It is not expected to be repeated. So the net profit would be higher. It means either A or B. Next, fixed assets turnover, that is sales upon average fixed assets. What about this? The land was already impaired in the last year. It was written down. The balance on the land last year and current year are the same. 15 million was charged when asset turnover was calculated. The land had already been impaired. The charge was made to profit and loss account. The value of the land is same as it was at the end of the last year as it is now. Since sale is not changing, we have no indication that there is a change in sale. Average fixed assets stay the same. Hence, we can say that the assets turnover, fixed assets turnover, it will remain the same. It will be unchanged. So profit would go up because of one-time charge, but land last year closing balance and current year after write-off would remain the same. So the asset turnover, fixed asset turnover, they will remain the same. So that makes B to be the correct option, and B it is. Next, if a firm has a net profit margin of 0.05, an asset turnover of 1.465 and leverage ratio of 1.66, what is the firm's return on equity? It's a typical DuPont computational question. Let me write down the complete DuPont formula. Return on equity is equal to net profit percentage multiplied by the asset turnover multiplied by the leverage ratio. This leverage ratio is sometimes referred to as equity multiplier. It is sometimes called equity multiplier. So remember, they can be either of these. So we just need to plug in the numbers, that's all. You just need to know the formula. Just plug in the numbers and you get your result. So we have net profit percentage 0.05. Assets turnover ratio is 1.465 multiplied by leverage ratio, which is given as well, 1.66. Simplifying all these will get you your answer. 0.05 times 1.465 times 1.66. That gives you 0.121595. So that is very close to 0.1215, approximately 12.16%. So this is your return on equity, and this is the DuPont model for return on equity. So that makes C to be the correct option, and C it should be. We have a different option, but C is the right answer. I think the slides are a little jumbled. C is the correct option. Next question, number 7. Earnings before interest and taxes is also called as what? EBIT. I have little disagreement with this question. Your question says earning before interest and tax is also known as operating profit. So far so good, because this is the best option out of these. But this is not always true. This is not always true. Why? Because your operating profit is also adjusted for certain expenses, certain losses, certain gains that are reported outside the business operation. Gain on disposal, it is not a part of operation. Loss on disposal, right? So they are reported outside operating profit. But out of these three options, yes, EBIT is equal to operating profit, but it is not always the case that operating profit and EBIT would be the same. Nonetheless, B is the right answer, so that makes B to be the correct option. Next, common size income statement expresses all income statement items as a percentage of what? If you have read the theory, the notes that were shared, you should know that all the items in income statement, sales, CGS, your various type of expenses, they are expressed as a percentage of sales. In a vertical size common size analysis, when you have 2020 numbers, sales and all these, sales is considered as 100 and all the numbers below these are expressed as a percentage of sales. This is called the vertical common size financial statement analysis. In the horizontal one, what we do, we have our prior year numbers like for 2016, 2017, 18 and 19. We can take all these numbers as our basis. Sales for 2016 would be taken as a base, and every year sale will be expressed as a percentage of sales in 2016. Cost of goods sold in each of the following years, 17, 18, 19, would be expressed as a percentage of sales, cost of goods sold in 2016. This would serve as a base, and all these years would be reflected as a percentage of the base year. This is called horizontal common size income statement analysis. But we're talking about just the percentage. Most of it we use vertical common size analysis, in which we take the sale as a base and every element is expressed as a percentage of sales. So that makes B to be the correct option, and B it is. Now we're talking. Gold Star Manufacturing has an accounts receivable turnover of 10.5, an inventory turnover of 4 times, a payable turnover of 8 times. What is the Gold Star's cash conversion cycle? You need to know the formula for cash conversion cycle. Let me write it down. Cash conversion cycle, CCC for short, is equal to account receivable turnover in days. Remember, everything has to be in days for cash conversion cycle, plus inventory turnover, it must also be in days, and from this we deduct the accounts payable turnover, and it must also be in days. But we haven't been given the numbers in days. We haven't given in times. The simplest, the quickest way to do it is to divide these with 365 divided by 10.5 times. It will give you account receivable turnover days. 365 divided by 4, it will give you inventory turnover days. How many times, after how many days your inventory sold. And 365 divided by 8 will give you the accounts payable turnover or average payment period, average collection period, average inventory period. So we're going to do the same thing, 365 divided by 10.5 plus 365 divided by 4 minus 365 divided by 8. Now simplifying these one by one, 365 divided by 10.5 gives you 34.75. It means on average our customer pays us after 34.75 days. 365 divided by 4, that is 91.25. It means our inventory is sold out in 91.25 days. We have to purchase it again. In other words, we have to replenish our inventory after 91.25 days. Less accounts payable turnover in days, 365 divided by 8. That means our average payment period is 45.625 days. Means we pay our accounts payable after approximately 45 days. So summing this up all or simplifying this should give you the net answer. It's 80.38, which is the exact answer, A, right? This is the quickest way. Don't do them separately and then plug in the formula. You can simply plug all the numbers in a single go and then solve it in just one single step. So the cash conversion cycle is 80.38 days. That makes A to be the correct option, and A it is. What would an increase in net profit margin or in the firm's dividend payout ratio increase firm's sustainable growth rate? Sustainable growth rate, whatever we have read so far, it is CFA level 1, but whatever we have done so far, it is there in CMA part 2, financial statement analysis. So this sustainable growth rate is there in your CMA part 2, section A, financial statement analysis. And I'm sure you would know the formula. Sustainable growth rate, SGR for short, is equal to return on equity into 1 minus dividend payout ratio. Dividend payout ratio, DP ratios. That's called the sustainable growth rate. What is measures? You need to know. Now, how does net profit margin and dividend payout ratio affects sustainable growth rate? The question is, would an increase in net profit margin or in the dividend payout ratio increase or decrease sustainable growth rate? Increase, in fact. Let us see one by one. If your net profit percentage goes up, net profit percentage feeds into return on equity. Your return on equity would go up. And when your return on equity goes up, there is no doubt your sustainable growth rate would go up as well, keeping other factors constant. So yes, if net profit margin goes up, your sustainable growth rate goes up. It makes sense. What about dividend payout ratio? Dividend payout ratio means, let's say you distribute 30% of your earning to your stockholders, which means what you retain, retention ratio is 70%, right? Now let's say if your dividend payout ratio has been raised to 60%, that will leave only 40% of retained profits, so your sustainable growth rate will fall. So if you pay out more, if the dividend payout ratio is increased, your retention rate goes down. When your retention rate goes down, your sustainable growth rate falls. The formula suggests that if there is increase in dividend payout ratio, there would be no increase, rather there would be decrease in sustainable growth rate. So it's no, in this case no. So the only combination that is good at both sides is option A. So A it has to be, and A it is. Yes, no. Alright, next question. Now I would spend some time on this for you people to get some good idea. Before we do this question, let me just give you some tip for managing ratio analysis. If your current ratio, quick ratio, working capital ratio, cash ratio, whatever, if it is greater than 1, and if as a result of any transaction there is an addition in the numerator to the ratio and to the denominator, any transaction that results in same increase in the numerator as well as denominator, it will cause the ratio to fall. Quick way, without computation, you can just give your result. All right. And if the same number is deducted from the numerator or denominator, the ratio would improve. Okay, if you ask me for the proof, just let me give you. Let's say your current ratio is 200 numerator and 100,000 denominator. So that means the ratio is 2. That is clearly more than 1. Try purchasing some inventory on credit. Let's say I bought goods worth 50,000 on credit. That will increase my numerator by 50,000 as well as my denominator by 50 because goods have been bought on credit. So that will be 250 by 150. Now look at what the ratio is now. 250 by 150. The ratio now is 1.66. It has fallen from 2 to 1.66. Conversely speaking, let's say we have paid out to our account payable. Let's say we have paid 70,000 to our account payable. When you pay to your account payables, your current assets will fall by 70. Your denominator would fall by 70. Resulting the new ratio now is 130 by 30. It's massive, 4.33. See? So when the same number is added to the numerator and denominator, the ratio falls. If the same number is deducted from the numerator and denominator, the ratio would increase. That's the shortcut. Now, if your current ratio or quick ratio or working capital ratio or cash ratio, for any ratio for that matter, if it is less than 1, and if there is any increase in the numerator as well as denominator, the ratio would improve. And if the same number is deducted from the numerator and denominator, the ratio would decline. Let's test this. Let's say we have our current ratio 50 by 100, which means it's 0.50. And 0.50 means less than 1, right? Let's try buying some stock on credit. Let's say I've bought goods worth 80,000 on credit. So buying goods worth 80,000 on credit will increase my numerator by 50. By 80, that will be now 130. The denominator would go up to 180. Now look at the ratio now. 130 by 180. Yes, it has improved from 0.5 to 0.72. Now do the reverse. Try settling some of your accounts payable. Let's say I pay 30,000 to my account payable. When I pay 30,000 to my accounts payable, my numerator will fall by 30. My denominator will fall by 30. And now see what's the ratio now. 20 by 70. The ratio has deteriorated. It has become very dangerous, 0.28, right? So this is the quick way to tackle question like these. We don't need computations, like just we can do this thing. Your quick ratio is equal to 2. That is, your quick ratio is greater than 1. A decrease in inventory and an equal decrease in accounts payable. If the same number is reducing in the numerator and denominator, we should expect an increase in quick ratio. The ratio would increase. Without numbers, we give our answer and it's correct. B. That's how you do it. Next. Eagle Manufacturing Company reported the following selected financial information for the next 7. What we are required, assuming 365 days in a year, calculate Eagle sales for the year. This is a very twisted question. Lots of information is given. We have been given accounts payable turnover, which means we pay our suppliers 5 times in 1 year. We have been given CGS. We have been given average inventory, average receivables, total liabilities, interest expense, cash conversion cycle. What to do? We should take this our starting point. This would serve as our starting point. We will take our cash conversion cycle, which we know is equal to account receivable turnover days plus inventory turnover days minus account payable days, means the average payment period. Alright, so our cash conversion cycle is 13.5 days. Account receivable turnover in days, do we have the data for this? The formula for account receivable turnover in days is equal to your average account receivable upon net credit sales, if not given take sales, multiplied by 365. Do we have AR? Yes, we do, 8 million. Do we have sales? No. In fact, that's what is needed. Sales for the year is required. That's the requirement, X. Multiply this with 365. Inventory turnover days. What's the formula for inventory turnover days? Inventory turnover in days is equal to your average inventory upon CGS multiplied by 365. Do we have the numbers? Do we have the average inventory? Yes, we do. 3 million. Do we have the CGS? CGS is there, right? 30, yes. And multiplied by 365. Accounts payable days. We have already been given the accounts payable turnover. We can simply divide 365 with this. You'll get your answer. It's just an equation on X, which you just have to simplify and you get your answer. Simple as that. So it's 13.5 is equal to 8 times 365 gives you 2920 upon X. Simplification of this should give you 3 upon 3 times 365. That's 36.5. 365 upon 5 gives you 73. You just have to make X the subject of the equation, and that's all. Simplifying these first, 36.5 less 73, and taking this to the other side of the equation, deducting this 13.5, that gives you a total of 50. Taking all these here, you get a 50. 2920x upon X is 50. That means X is equal to 2920 upon 50, and that will give you simply the result, 2920 upon 50. That is 58.4 million. That was the missing number. This is the sales, and that makes A to be the correct option. And A it is, 58.4. Next question. What is the net income of a firm that has a return on equity of 12%, leverage ratio also called the equity multiplier 1.5, an assets turnover of 2, and a revenue of 1 million? So you need to know your formulas. If you know your formulas, you know what to do. So return on equity is equal to net profit percentage multiplied by the assets turnover multiplied by the leverage ratio, also called the equity multiplier. So plug in the numbers. Do we have net profit percentage? No. Do we have return on equity? Yes. Do we have net profit percentage? No. But we have the components of net profit. We have revenue 1 million. Assets turnover is given as 2. Equity multiplier or the leverage ratio is 1.5. And we know net profit percentage is sales. Net profit upon sales. Right? Net profit upon sales. We have been given the revenue 1 million. Net profit is something that we need to calculate. Net income. So 12% is equal to X upon 1 million times 2 times 1.5, and that's all. You just need to make X the subject of the equation and you will get your result. 12% times 1 million divided by 2 divided by 1.5, and that's all. So 1 million times 0.12 divided by 2 divided by 1.5 is just $40,000. So your net income is 40. You just need to know the formulas. You need to know how to manipulate them, how to plug in the right numbers in the right places, and that's all. That's all about financial statement analysis. And then interpreting the ratios, of course, that would come with the practice. The more you practice, the more refined your understanding would be. So A it is, and A it should be, 40,000. Next, during 2007, Brownfield Incorporated purchased 140 million of inventory for the year just ended. Brownfield reported CGS of 130 million. Inventory at the year end was 45 million. Calculate the inventory turnover. Now it's not a straightforward question because we know inventory turnover is equal to CGS upon average inventory, right? We have been given just the closing stock, the purchases, and the CGS. Fine, CGS can serve as our numerator. What about average inventory? Average inventory means your opening plus closing upon 2. We have closing but not opening. What to do? Use CGS. We know CGS is equal to opening stock plus purchases minus closing stock. CGS is given as 130 Opening stock is missing. Purchase is 140 million. Closing stock is given as 45. Make O the subject of this equation, and you get it 130 less 140 plus 45 gives you 35. That means your opening stock was 35. Plug it in. 35 plus closing stock 45. 35 45 upon 2 gives you an average of 40. And this is the average that you need to plug it in here. And that's all. You get your answer. So 130 million upon 40 should give you the final result. 130 million upon 40, that's 3.25. Your inventory turnover is 3.25, means your inventory is replenished or repurchased or sold out 3.525 times in 1 year. If you need to convert it in days, simple ways to just 365 upon 3.25. It will give you the inventory turnover in days. So that makes B to be the correct option. B it is. Next. Okay, we have been given balance sheet for the 2 years. We have been given the income statement for the current year. What is needed? What is the quick ratio? It's a very easy question. Easy or difficult, I recommend that you should do as many questions as you can. Practicing on question is the main thing that will help you get through the exam. Speed, that will build your speed and accuracy. So we need quick ratio. For that we need to know the formula. Quick ratio is equal to quick assets. When we say quick assets, means for 2004, it means cash, it means account receivables, no inventory, no prepayments. So just 450 plus 660 divided by your current liabilities. Current liabilities are given right here, 550. These are long-term debts. So that's all. That is the simplest possible question you can see in ratio analysis. 550. That is 2.018. So that makes A to be the correct option. A it is. Simple as that. This is a good one. This is a toughie. Apparently, you will find it hard to solve return on equity. Return on equity. Apparently, you can do it directly. 2 by 8. But most of you would be used to using DuPont model. That will, what should we do? You will apply DuPont model. Return on equity requires net profit percentage. We don't have it. Requires assets turnover. We don't have it. Requires the leverage ratio. We don't have it. What to do? We know the component parts of it. This is the long shot. Net profit percentage is net profit or net income upon sales. Assets turnover is sales upon average total assets. And a leverage ratio is equal to total assets, average total assets, upon average total equity, or just equity in this case. You can do this directly. Return on equity is equal to 2 by 8, and there you go. 25%. That's your answer. But we are just playing with the question. What if we need to, and what if we have to solve it using the return on equity, DuPont version? What we will do, net profit or net income is 2, sales is 10, assets turnover 10, total assets 10, equity 8. Eventually what you will be left with is the same, 10, 10, 10, 10. All 10, 10 are gone. You are left with 2 by 8. That is of course 25%. So this is a short way of doing it. Save your time. Follow the, but since most of you are used to using DuPont model, you'll try to use this method and probably you'll get stuck. Right? So that makes A to be the correct option, whichever method you take, short, or the long route. Next, which of the following ratios would least likely measure liquidity? Okay. Current ratio is a measure of liquidity. We have read it many times. We've done many questions like these. It's a measure of liquidity. Quick ratio is a measure of liquidity. Cash ratio is a measure of liquidity. Return on assets, it's the measure of profitability. So the question was, which of the following ratios would least likely measure liquidity? B. Because B is the measure of profitability. That makes B to be the correct option. Okay. When there is a very easy question, you can just skip it, but I don't recommend skipping. Do them all. Do all the 4,000 plus questions. That will give you the needed confidence, the speed, the accuracy, and that is what is needed. good reading, and then lots of practice of questions. That's what you need to get through the exam. When the return on equity is decomposed using the original DuPont system, what three ratios comprise the components of ROE? We've just seen the return on equity is equal to net profit percentage times assets turnover times the leverage ratio, or called the equity multiplier. Here we go. B, net profit margin, assets turnover, and equity multiplier, also called the leverage ratio. So that makes B to be the correct option, and B it is. Next. Alright, it's a good one. Are the following ratios best classified as profitability ratios? Ratio 1 and ratio 2. Let us see. Cash plus short-term marketable securities. We are talking about profitability ratios. Cash plus short-term marketable investments plus receivables divided by average daily cash expenditure. This represents the cash available divided by your daily cash expenditure. It's a measure of liquidity. How much cash do you have to meet your daily expenditures? It's not the measure of profitability. It's the measure of liquidity. Right? Ratio 2, earnings before interest and taxes divided by the average total assets. That is return on assets, and return on asset is a very much profitability measure. So are the following ratios best classified as profitability ratios? Only one of them is correct. Only one of them is ratio for profitability. The other one was for liquidity, so that makes C to be the correct option. And C it is. Now, again a good one. Lightfoot Shoe Company reported sales of 100 million for the year ended 2007. Lightfoot expects sales to increase by 10%. Cost of goods sold is expected to remain constant at 40% of sales, and Lightfoot would like to have an average of 73 days of the stock on hand in 2008. Forecast Lightfoot average inventory for 2008 assuming 365 days a year. What have we been given? Let us first analyze the data, and then we will do our magic of computations. We have been given the sales for the current year. The expected sales are going to be 10% higher, which means if the current sales level is 100 million, it is going to go up by 10%, which means the revised sales number for the next year would be 110 million. Okay. It says CGS is expected to remain constant. And what is the constant? 40% of sales. That means CGS is simply equal to 40% of your 110 million. That would be 44 million. Alright, what do we need now? If 73 days worth of inventory on hand in 2008, we need to calculate the average inventory for 2008. What he's requiring us to find out is the inventory turnover. We have 73 days of inventory, means our inventory turns in 73 days in 1 year. So our normal formula for inventory turnover in times, it's equal to CGS upon your average inventory. But if you need to find out the inventory turnover days, I am sure you people know how to manipulate the formulas. If you need to calculate directly inventory turnover days, how many days does your inventory last, after how many days do you replenish your inventory, or after how many days do you purchase? So all are the same. Inventory turnover days is equal to, it is just the reversal of this, average inventory divided by CGS times 365. Using this way, you can directly calculate what you need. So we have been given the inventory days, that is 73. We need to find out the average inventory, that is X. CGS has been given as 44 million and just 365. You just have to make X the subject of this equation and you will get your answer. 73 times 44 upon 365 will give you the result. 73 times 44 upon 365. That is 8.8. Since all the numbers are in millions, so your X is also in millions, so 8.8 million represents your average inventory or your average stock. So that makes C to be the correct option. And C it is. Here we go. What do we need? The data is given: sales, receivables, payable, purchases, COGS, inventory, net income, assets, debt to equity. What is the average collection period in days? Average inventory processing period, that is how long you hold your stock, and payables payment period means after how many days do you pay to your accounts payable. Now it's a good question to deal with these three formulas separately that directly give you the result in days. So what do we need first? Average collection period, also called the account receivable turnover days. It's equal to your average account receivable. I'm going to directly write the formula upon your net credit sales or sales multiplied by 365. This will return you the result in days. Average inventory processing period, or the inventory turnover days, for how long you hold on to your inventory before it is sold. It's just, we calculated in the previous question, your average inventory upon CGS multiplied by 365. Payables payment period, that is the average payment period, that is your average payable, account payable, upon your average purchases. Just like account receivable upon sales, account payables are driven by purchases, so we need to write these in the denominator multiplied by 365. Now plugging in the numbers, account receivable average is 260, I'm omitting zeros. Sales is 1 million, I'm omitting 3 zeros, times 365. Inventory average, or just inventory, is given as 400, omitting zeros, upon CGS that has been given as 800 multiplied by 365. The last one, accounts payable 600,000, purchases 800 multiplied by, it's just the three formulas have been checked in a single question. So it's 260 by 1000 times 365 gives you 94.9. The next one will return 400 by 800 times 365 gives you 182.5, and 600 upon 800 times 365 returns 273.75. So the results have been rounded off. The nearest numbers are given: 95, 183 and 274. So we took time, but in the exam you have to be quick, and this will come with practice. Speed and accuracy is needed in professional certification. So this makes A to be the correct option. A it is. Next, what type of ratio is revenue divided by average working capital, and what type of ratio is average total assets divided by average total equity? Let us analyze this. What type of ratio is revenue divided by average working capital? This is the first one. And what type of ratio is average total assets divided by average total equity? Average total assets is divided by average total equity. It is called equity multiplier or leverage ratio. And a leverage, gentlemen, is a measure of solvency. Leverage is a measure of solvency, whether business will be able to meet its long-term obligations when they become due. Liquidity is the abilities of a business to pay its current obligations when they become due. All right. Now, what about revenue upon average working capital? That is, revenue means sales upon working capital, that represents your assets. Sales upon assets, it's similar to assets turnover. And assets turnover is what type of ratios? It's an activity ratio. It's an activity ratio, which means the common part that is correct on both sides is B. Revenue upon average working capital is an activity ratio, and average total assets upon average equity is solvency ratio. It's basically the leverage ratio is called the equity multiplier. So that makes B to be the correct option. This is how analytical you need to be. Observant, sharp, focused, careful in extracting the information from the given data. Be it theoretical or computational, observant. You have to be observant. Next, question number 23. Instead of just reading the whole question like a moron, the right approach is just to look at what is needed so that we can just focus our efforts on what is exactly required. The question looks big, but what we need is a very little part of it. We need current ratio, and we know current ratio is the current assets upon current liabilities for the 2000X4 year. So this is current assets Upon current liabilities, the current liabilities are given right here. That's all. I simply ignored whatever is given. I needed what I needed. And that's quick ratio. When you say quick ratio excludes stock, it excludes prepayment. Explicitly, these are two excluded. These are quick rate assets, cash, account receivables, or if they were marketable securities. This divided by current liabilities. So the red one will give you the quick current ratio and the black one will give you the quick ratio. So it's simple as that. You just need to calculate this. 12,297 divided by 7735. It gives you 1.589. 1.589. And for quick ratio, you just need to take 2098 plus 4570 divided by 7735. That gives me 0.862. So this is the closest one. That makes B to be the correct option. And B it is. Alright, next one. Cash conversion cycle. It's all about the formulas. If you have grip over the formulas, you would have no issue in solving any computational ratio questions or even theoretical. Even formulas, if good understanding of formulas will help you answer theoretical questions also. It shouldn't be a big deal. Alright. So an analyst has collected the following data about a firm: receivable turnover, inventory turnover, payable turnover. Your mind will process this information at a great speed if you have practiced well. What is the cash conversion cycle? It is simple as that. Cash conversion cycle, and I'm going to straight plug in the numbers in the formula. 365 upon 20. That will give me the account receivable days. Inventory turnover 16. 365 upon 16. That will give me for how long I keep on my inventory. Minus accounts payable turnover, that is 365 divided by 24. It's as simple as that. So I'm going to do it all in a single go. 365 by 20 plus 365 by 16, and from this I need to deduct 365 by 24. It gives me a final result of 25.85, which is 26 days approximately. So that makes B to be the correct option. Save your time, you know the formula, plug in the numbers and simply select the option and move on. It's a good one. A good one. Need certain twists and turns. Callan Harris is a credit analyst with the First National Bank. Harris has been asked to evaluate Longhorn Supply Company's cash needs. Of course, cash needs. We are studying ratio analysis. Harris began by calculating Longhorn's turnover ratio for 2007. After discussion with the Longhorn's management, Harris decided to adjust the turnover ratio for 2008 as follows. These were the actual turnovers for 2007. There are some expected changes. Account receivable turnover is going to go up by 10%. Fixed assets turnover plus increase. Accounts payable decrease. Inventory turnover decrease. There is no change in equity. Total assets turnover is going to go up as well. Very good question indeed. We need to save time. We need to find a quick way to get our result. Longhorn's expected cash conversion cycle based upon the expected changes in turnover and assuming a 365 days a year. If we start computing each number separately and then plug it in the formula one by one, it will take a lot of time. What we should do, we should follow a smart approach. What is the smart approach? This is the smart approach. You will write cash conversion cycle is equal to, we know that, it's first the account receivable, 365, divided by account receivable turnover. We can't take 5 because it is going to go up by 10%. So instead, first calculating increase separately, then plug it into the formula, go straight with 1.1. This will increase account receivable turnover by 10%. Simple. Plus, what about next one? Inventory turnover in days. It has fallen by 5%. So it's going to be 365 by 4, but 4 has fallen by 5%. So we can just multiply this with 0.95. Save your time, get your result. And then lastly, accounts payable turnover is 6, it has fallen by 20%. So you do the same thing, 365 upon 6, and this 6 has to be reduced by 20%. You simply multiply with this 0.80. See, you save your time. In a single go, you have plugged in all what you needed and you get your answer. So it's 365 divided by 5 into 1.1. I could have done it in a single go, but I thought just to write these one and separately. 66.36 plus 365 divided by 4 times 0.95 gives me 96.05, and then 365 divided by 6 times 0.80, it gives you 76.04. That's all. You got your result. 66.36 plus 96.05 minus 76.04, and there you go, 86.37. And the closest result, as it says, is B. See, we did it just in a single line instead of just computing each number separately and then finding the final answer would have wasted a lot of time. Next question, question number 26. As I said, do not start reading every question from A to Z. First look at what is needed. Gross profit margin. You know what it means? It means I just need to look at the gross profit and sales and everything is totally irrelevant for me. Simple as that. Gross profit expressed as a percentage of sale, 2 by 3000, that gives you 66.67%, or if given in decimals, it's 0.666. That's all. You click and move on. B. B it is. Again, a bigger question. Look at the requirement is needed. Which of the following is closest to the company's return on equity? When you say return on equity is equal to your net profit divided by average total equity. The question that you should be asking me, why average? Why net profit straight away, and why do we need to take average? The reason is, whenever in ratio analysis, whenever we combine an income statement item with the balance sheet item, income statement is for the whole period, is for the whole year or whole period. This net profit is for the whole period. Then why do you take the equity, the closing equity? Why do you take the closing equity? Equity should be taken for the whole year, but unfortunately equity cannot be taken for the whole year. What we can do the best is we can take the average opening equity, common stock plus retained earning, plus closing equity and divide it by 2. Averaging our equity this way will somehow give it an annual feel or an annual impact. So 1400 was our opening equity, 538, 1100, 1638 was our closing equity. Dividing it with 2, it gives us 1519. That's all. So return on equity is net profit, that is 944, upon average equity, that is 1519, and simple. 944 divided by 1519, that you got your answer. It's 0.621. 0.621, and that makes C to be the correct option, and C it is. Again, big question apparently, but what is needed is something very small. What is the inventory turnover ratio? What we need is CGS upon average inventory. What is CGS? Right here, 1100. What is the average stock? We have been given balance sheet for the current year only, so we can't calculate average. When average is not possible, CGS is for the whole year. Inventory must be the whole year as well, must be an average, but we can't find the average because we have just been given the closing balance sheet. So we can at least calculate 1100 upon 850. Whatever is given, use it. It's 1.25 29, so that makes C to be the correct option. And as you can see, C it is. Ratio analysis is most useful for comparing which companies? In different industries that use same accounting standards. That is fine, same accounting standards are required by the law, FASB. But comparing result of different industries, we compare like with likes. We compare potatoes with potatoes, oranges with oranges. We don't compare onions with potatoes. It has to be like versus like. That is incorrect. Companies that operate in multiple lines of business. Companies that operate in multiple lines of business, such businesses are called conglomerates, well diversified, and comparing such businesses will be misleading because we are not comparing likes with likes. Because a company A might be involved in business A, business B, C, D, E, and we are comparing it with another company with multiple products, X, Y, Z. So we can't compare the results. We are not comparing like businesses with likes. Right? Yes, ratios can be used for comparing companies of different sizes in same industry. Industry is the same. They are in the same field. One might be bigger, other might be larger. So instead of comparing them on dollar basis, we compare them on ratios. So ratios are a good tool to compare companies of different sizes in the same industry. Common size analysis is also a tool that we use to compare businesses of different sizes in the same industry. So that makes B to be the correct option. And as you can see, B it is. Next, are the quick and debt to capital ratio used primarily to assess the company's ability to meet short-term obligation? Quick ratios are used to calculate the company's ability to pay current liabilities. Remember, quick ratio assesses the company's ability to pay current liabilities. Debt to capital ratio assesses the company's ability to pay long-term liabilities. So yes, short-term obligations payment ability is assessed through quick ratio, but not through debt to equity ratio, debt to capital ratio. So it's yes, no combination. That makes B to be the correct option. Next, statement 1 and statement 2. With respect to these statements, which of these are correct, I think? Let us read the first one. As compared to the price to earning ratio, called PE multiple, the price to cash flow ratio is easier to manipulate because management can easily control the timings of cash flows. Price to cash flow is difficult to manipulate because market price is not in your control. But look at this. Earnings can be manipulated. Market price may not be in your control, but earnings can be manipulated through aggressive accounting. Right? So this first ratio is probably more prone to manipulation rather than the second one. Right? So this is comparatively. So as compared to price to earning ratio, the price to cash flow ratio is easier to manipulate. This is wrong because market price is not in your control. The market price of your stock is determined by the forces of demand and supply that are not in your control. Otherwise, company would have manipulated the share price to give a positive signal to the market. So this is an incorrect statement. Statement 2. A firm with earnings per share of 2 is more profitable than a firm with earning per share of 1. Earning per share basically calculates your earnings divided by number of shares. So it's not just profit only. What if a company has very few number of shares? Resultantly, EPS would go up. So we can't say that through EPS we can compare two companies are more, one is more profitable, other is less. This is incorrect because EPS is determined by two measures. First is the profitability and second is the number of shares. So what if a company has less number of shares? EPS will look artificially inflated. So this is not right. So both of these statements are incorrect, wrong. So that makes A to be the correct option. Next, Again, a bigger question, but I always suggest look at the requirement and then straight away follow what is needed. Determine the current and quick and cash ratios. Simple. Current and cash ratios. Current ratio means current assets upon current liabilities. These are your current assets. Current assets and upon current liabilities. These are your current liabilities. Accounts payable and short-term debt. That's all. This will give you the current ratio. What if you need the quick ratio from the same data? Quick ratio will consider only the cash ratio only, not quick ratio. Cash ratio. It was cash. Cash means only cash and marketable securities. This upon this. It will give you the cash ratio. It's as simple as that. So it's 100 plus 750 plus 300 plus 850 divided by the sum of 300 and 130. It gives you a total of 4.65. For cash ratios, what you have is just two things, 100 and 750, and you have the two denominator values, 130 and 300, that's 430. It gives you 0.93. So that is 4.65, 0.93. B, simple as that. It's a very simple question. Okay, the previous question was simple. What about this? It doesn't look to be a simple one. You need to read the whole of it. In the year 2004, a company had net profit margin of 18%, total assets turnover 1.7, financial leverage multiplier 1.5, also called the equity multiplier or the leverage ratio. If the company's net profit margin declines to 10% in 2005, what total assets turnover would be needed to or in order to maintain the same return on equity as in 2004? An amazing question indeed, a super question that involves many twists and turns. So how to tackle a question? What we have got so far that we need DuPont model for this question. Return on equity is the net profit percentage times assets turnover times the leverage ratio. So in 2004, the company had a net profit margin of 18%, assets turnover of 1.75, financial leverage of 1.5. Calculating these all gives us the return on equity. It's 0.475. Okay, this is related to 2004. What now? It says what total assets turnover would be needed in order to maintain the same return on equity. We need the same return on equity, 0.475. It says the return on equity has to be the same. What should be the new assets turnover? Net profit percentage has also fallen from 18% to 10%. Your leverage ratio hasn't changed. Right? We just need to find this unknown. Keeping this unknown here and taking all the measures on the other side of the equation, 0.475 upon 1.5 upon 10%, simplification of this gives you 3.15. 3.15, that makes B to be the correct option. B, and B it is. Next, this is the one we did. Companies are required to report segment data under what? We studied a little while earlier. Segment data is needed in the case of US GAAP, but those who have read the text, segment data is required for IFRS as well. So remember, the segment data is needed under IFRS and US GAAP, both. That makes B to be the correct option. Segment means under the US GAAP, a division of a business that has its unique risk return profile and it has assets at least 10% of the total assets of the firm. Its results must be reported separately. So segment data, segment results are required for under IFRS as well as US GAAP. So that makes B to be the correct option. Next, given the following information about a firm, what is the return on equity? Simple, we have mastered this formula. Return on equity is the after-tax profit margin multiplied with the assets turnover times financial leverage, and that's all. 10.1 times 1.2 times 1.5 gives you 0.18 or 18%, straight as it is. A is the right answer. A it is. See, simple as that. Now this question looks little bigger. Again, what is needed? Analysis of this statement of trends in operating profitability reveals that with respect to Royal's gross profit margin and net profit margin, we have been given 2 years, and we are most probably required to assess the trend. 2 years are given: 2000x0, 2000x1. We need the gross profit numbers and we need the net profit numbers for both years. Simple. Gross profit 31 by 78. It gives you 39.9. Then 34 by 82 for the next year is 41.46. 41.46%. So GP has gone up, as you can see. Now what about the net profit margin? This is your net profit right here. Earnings after tax 7. 7 by 78 is 8.9%. 6 by 82, it's 7.3%. So you can see the net profit percentage has fallen. So what we can conclude, gross profit percentage has increased, net profit percentage has decreased. Yes, correct. A is the right answer. Gross profit percentage has increased, net profit margin has fallen. That makes A to be the correct option. Okay, which of the following is the closest estimate of the firm's sustainable growth rate? This question needs some serious thinking. We can do it from two aspects: the long shot and the quick way. Let's see. We know the formula. The sustainable growth rate is equal to return on equity multiplied by the retention rate, or simply 1 minus dividend payout ratio. Right? So in the first way, we can directly calculate return on equity and multiply it with the retention rate. Net profit margin is 15%. Right? 15% of what? 15% of sales. 15% of sales means 10 million times 15%. That gives you 1.5 million. This is your net profit. What is equity? 11 million. So you can calculate return on equity straight away from here. 1.5 million upon 11 million multiplied by 100. Right? So 1.5 upon 11 million multiplied by 100. That is 13.636. 13.636. So sustainable growth rate is equal to return on equity, that is 13.636 multiplied by 1 minus dividend payout ratio. Payout ratio has been given as 35%. This is the quick way to solve the question. 1 minus 0.35 times 13.636 gives you 8.863%. This is your sustainable growth rate, and it can't be 8, of course. Closest is 9. A. What about the long shot? Long shot, return on equity is calculated by the data given. And what is the net profit percentage, assets turnover, and a leverage ratio? And then we plug it in the formula. So net profit percentage is 15%. Assets turnover, that is sales, 10 million upon average assets, 15 million. What about leverage? Leverage is the total assets divided by equity. Equity is 11. So if you simplify all of these using DuPont model, you should know this model as well. 10 by 15 times 15 upon 11 times 15%. It's exactly the same 13.636% return on equity. And now you can simply plug it in. Return on equity, payout ratio, you get the same result. So multiple ways. Sometimes one would work when the data is supportive, and sometimes you may have to follow the long shot. So you have to be expert at both. So we got the answers. A, 9%, so that makes A to be the correct option. Question 38. In preparing a forecast of the future financial performance, we have many tools available. Which of the following best describes sensitivity analysis and scenario analysis respectively? Sensitivity analysis and scenario analysis. Let us analyze these descriptions one by one. A computer-generated analysis based on developing probability distributions of key variables one at a time. One at a time. A computer-generated analysis based on developing probability distribution of key variables that are used to drive the potential outcomes. It is called simulation analysis. If you have read your theory, you would know it is simulation analysis, where we use probability distribution to determine the variability in a single variable in the project. Description 2. The process of analyzing the impact of future events by considering multiple key variables, building different cases, different scenarios. It is called scenario analysis. What about description 3? A technique whereby a key financial variable are changed one at a time and a range of possible outcomes are observed. It's called a what-if analysis. Like, for example, I have a project under consideration and its net present values being assessed under different circumstances. There are many variables that affect the net present value, includes direct material, direct labor, tax rates, overheads. Changing these variables will impact net present value. If I increase my 10% cost related to material, how would it affect my net present value? If the tax rates go down by 5%, how would it affect my net present value? This is called what if. What would be the outcome if tax rate goes down by 5%? This what if analysis, gentlemen, it's called sensitivity analysis. So description 3 is describing sensitivity analysis. Description 2 is describing scenario analysis. And description 1 is simulation analysis. So sensitivity analysis in description 3, scenario analysis in description 2. So this matches perfectly. That makes A to be our correct option. And as you can see, it is. Next, Paragon Company operating profits are $100,000, interest expenses $25,000, earning before interest and taxes $75,000. What is Paragon's interest coverage? It's a very simple question. Interest coverage, sometimes also called the times interest earned. How we calculate? Earning before interest and tax upon interest. Simple as that. So your operating profit or earning before interest and tax is $100,000 and your interest is $25,000. The result is 4 times. Now what this result tells us, that we can pay our interest 4 times out of the given profits. Our profits are so sufficient, so huge, that we can pay our interest 4 times out of the given profit. Even we have to pay it once. This tests your level of sufficiency of profits to make the payments for interest. So we can pay interest payments 4 times. This is the significance of the profits we have earned. Next, so that makes A to be the correct option. It is. Again, just look at what you need. What is the operating profit margin? This is a joke at this level. This is a joke at this level. You are highly qualified people. Requiring you to calculate profit margin is a joke. And when you say operating profit margin, it means you need to take earning before interest and tax. This is earning before tax. Earning before interest and tax would require addition of interest expense. So you need to add this back, 1349 plus 151. This is your operating profit. Dividing this operating profit with the sales, that is 3000, gives you your operating profit margin. If you calculate this all, 1349 plus 151, 1500 by 3000. It's a perfect 50%. So that makes A to be the correct option. Right. Question 41. McQueen Corporation prepared the following common size income statement for the year ended December 31st, 2007. Sales has been given as a base. Common size, vertical common size analysis. Cost of goods sold is 60% of the cost of sales. Gross profit is 40%. Okay. For 2007, McQueen sold 250 million units at a sales price of $1. It's always advisable. Percentages, it is recommended that you should convert them in numbers. 2007, and how many units did we sell? 250 million units, each at $1. Means the total sale revenue was $250 million. All right. For McQueen, 2008 has decided to reduce its selling price, but let us first complete this. Last year, 2007, sale was 250 million. CGS was 60% of this. 250 million, 60% means 150. Deducting this will give you your gross profit, which should be 40% of 250, and which is of course 100 million. This was the case last year. For 2008, McQueen has decided to reduce its sale price by 10%. McQueen believes the price cut will double the unit sales. If the price is reduced from $1 to 0.90, it will double your units sold to 500 million units. So what is going to be the new sales revenue for the next year, 2008? It's going to be 250 millions doubled, unit are doubled, the selling price now 0.9 per unit. So the revenue that you will get in 2008 is 450 million. The cost of each unit sold is expected to remain the same. Cost of sale is expected to remain the same. Calculate the change in McQueen's expected gross profit for 2008, assuming the price cut doubles sales. We have seen this. Now, CGS should only be doubled, 150 to 300 million. Why? Because it said there is no change in cost of sales. If the sale quantity doubled, the cost of sales will be doubled. And why the sales wasn't double? Because the selling price was reduced to 0.9. That's why the revenue is less than 100%, whereas the cost of sale will be twice as before. So your new gross profit would be 150 million, which is $50 million more than the gross profit last year. So that makes A to be the correct option. A it is. Next. What are the interest coverage ratio? Interest coverage ratio, also called the times interest earned, is equal to earning before interest and tax upon your interest expense. As simple as that. And we need net profit margin also, no big deal. Earning before interest and tax is 115. Okay. What is the interest expense? Interest expense is 15. Here it is. So 115 by 15, this gives you 7.666. What about net profit margin? Net profit margin is, here we go, 60 by 200. 60 is what percent of 200? Gives you 30%. So 30% and 7.67. So that makes C to be the correct option. C it is. Next. Too easy, too simple, an insult for CFA candidate, but nonetheless, I haven't added these questions. Don't blame me. These questions have been added by the publisher. We are just solving them. So very easy. Gross profit margin. That is gross profit as a percentage. What is gross profit? It's simply 1000 less 600. Gross profit is 400. So 400 is what percentage of selling price? Of course, 40%. Then what is the net profit percentage? Sales less cost of sales, less operating expenses, less interest expense, less tax. Deducting all these should give you the net operating profit. We just need operating till here. So 1000 less 600 less 200 gives you $200. This $200, your operating profit is what percentage of sales? 20%. And there you go, 40, 20. That makes C to be the correct option. C it is. Next question. Question number 44. A firm has cash conversion cycle of 80 days. Okay. The firm's payable turnover goes from 11 to 12. From 11 to 12, this is turnover. Sometimes it is difficult for us to assess whether it has increased the overall cash conversion cycle or not. It's always recommended to convert them in days. Your payable turnover has moved from 11 to 12. Means first it was 365 by 11. That means you used to pay after 33 days to your payable. Now you are paying more frequently. 365 by 12 means now you are paying after every 30 days. right? So you have started paying more frequently. First you used to pay 11 times in 1 year to your payables. Now you are paying 12 times in 1 year. How does it affect your cash conversion cycle? We know cash conversion cycle is account receivable days, average collection period, plus inventory turnover days, minus accounts payable payment period, right? So if it has increased, it has fallen from 33 to 30. It means accounts payable, average collection, average payment period has fallen. This number is now low. First it was 33, now it's 30. If it has fallen, you are deducting a smaller number. Resultantly, the whole cash conversion cycle will lengthen, right? So it's right to convert them into days, and then you can give your conclusions or assumptions. So that is the right answer. Your cash conversion cycle lengthens, so that makes B to be the correct option. Moving on, question number 45. The cash conversion cycle is the what? We have just seen, I think it's just written right here. Cash is gone. Cash conversion cycle, it's the sum of time take to sell the inventory and collect the account receivable, less time it takes to pay for the creditors. Yes, that is average cash collection period plus inventory turnover in days, and from this we deduct the average time we take to pay our suppliers. Without any doubt, that makes A to be the correct option, and A it is. Bigger question, always look at what is needed. We need receivable collection period. Receivable collection period, just what we need. Sales, account receivable, that's all. Khalas, 750 is the average accounts receivable, 1500 is the sales, times 365, and there you go. Simple as that, gives you an average of 182.5. That is the average time that our average customer takes to pay us, 182.5. That's approximately A. So that makes A to be the correct option. Yes, now this is something different. We haven't done any question like this before. And that's why I said that every LOS is covered in these questions. This question is the only one in entire 94 questions that covers a specific part of your LOS. We have been given three companies information: Jerome, Lawrence, and Morris. We have been given the sales mean, that is the average sale. Mean is average. We will study in our statistics. Standard deviation of sales. Net income mean, that is net income average, and standard deviation. What are we required to find out? Based upon only on these elements, the data, the analyst should conclude that relative to other two firms, one of the firms has the greatest uncertainty about sales, least uncertainty. How do we quantify uncertainty regarding your sales and net income? For this we have a formula. Have you read the whole formula sheet that I shared? You would know that coefficient of variation, whether it is for sales, income, or operating profit, it is given by this formula: standard deviation of divided by mean of what? Standard deviation of sales divided by means or average of sales, right? It could be standard deviation of your net income upon average or mean of your net income. And then lastly, standard deviation of your earning before interest and tax upon your mean or average of your earning before interest and tax. What does it measure? It measures volatility. It measures uncertainty. How come? Standard deviation, we'll study in statistics, it's a measure of uncertainty. It is a measure of dispersion. It's a measure of volatility. A company that has very volatile earnings, sometimes it turns very well, sometimes very bad, very well, very bad. It keeps on swinging up to, this is called volatility. This is despised. This is hated. This is a bad thing in stock market. Volatility, such deviations are considered bad. This deviation, this volatility, it is measured by a statistical tool called standard deviation, right? So standard deviation of sales, bad thing. Standard deviation of net income, bad thing. Standard deviation of earning before interest and tax is a bad thing. Standard deviation is a bad thing. It's a measure of volatility. It's a measure of risk, right? That's why we love consistent cash flows. Pakki Naukri. Why we love Pakki Naukri? Because the cash flows are consistent, regular, predictable. Those people who had Pakki Naukri, they are the luckiest now these days because they have consistent cash flows. without any worry whether the whole world dies because of corona. This is what you mean by volatility. Standard deviation is of any measure is a measure of risk, as a measure of volatility. So if we have high measure of standard deviation for sales, it means sales are very volatile. Results would be very uncertain. Same is true for net income and for earning before interest and tax. So this measures uncertainty, volatility. So let us calculate the standard coefficient of variation for sales, for net income. Just we have been given these two. Let us calculate. First we have the standard deviation of sales divided by mean. So I'm going to divide 400,000 with 1200. What I get is 0.33. So the first number is 0.33. 0.33 volatility or standard deviation per $1 of sales. How do we interpret this? The interpretation is, gentlemen, 0.33 volatility for every $1 of sales. For the next one, if we calculate 700,000 upon 3.5 million, that's 0.2. For this company, the standard deviation is $0.2 for every dollar of sales, less than the previous one. And the last one is 1.6 million as 6.4, it's 0.25. So the standard deviation is 0.25, or the variation in sales is $0.25 for every $1 of average sales. Same we can do for the net income also, that is standard deviation net income upon mean income, 80 upon 120, it gives you 0.667. 300 upon 400, that gives you 0.75. 400 upon 800, that gives you 0.50. Okay, now let's see. A. Morris has the greatest uncertainty about sales. Morris, this one is Morris. No, Morris has the average, not the greatest is Jerome for sales. This is incorrect. Jerome has the least uncertainty about net income. Jerome has least uncertainty about net income. Not least. Least is for Morris. This is incorrect. Lawrence has the greatest uncertainty about net income. Lawrence has the greatest uncertainty, $0.75 of standard deviation for every $1 of net income. Yes, that's the correct option. That makes C to be the correct option. It was just you applied the formula, you interpreted the result, and there you go. With other variables remaining constant, if the profit margin rises, how would it affect return on equity? We know ROE is the net profit percentage times the assets turnover times the leverage ratio, or called the equity multiplier. Keeping other factors constant, if your net profit goes up, your ROE will increase. So that makes C to be the correct option. Next, which of the following is a measure of firm's liquidity? Current ratio, quick ratio, these are the measures of liquidity. So let's see. Equity turnover is a measure of activity. Net profit margin is a measure of profitability. Cash ratio, that is cash plus marketable securities upon current liabilities. This is the measure of liquidity. C. C is the right answer. Next, question 50th. Regarding the use of financial ratios in the analysis of a firm's financial statements, it's most accurate to say that variations in accounting treatments have little effect on financial ratios. Wrong. Variation in accounting statements or accounting treatments have a very huge effect on financial ratios. It's an incorrect statement. Cross this out. Many financial ratios are useful in isolation. Wrong. Ratio analysis are meaningless in isolation. They have to be compared with some suitable comparator, like my current ratio is 2:1. This ratio will not speak for itself unless it is compared with the last year, or with my competitor, or with the industry average, or with my expectation, or with the budget. Ratios are more meaningful than when they are compared. Ratios in isolation have no meaning. Meaningless. Incorrect statement. A range of target values for ratios may be more appropriate than a single target value. Correct. My current ratio should be between 2:1 and 3:1. Having a current ratio more than 2:1 means I have more investment in current asset, which is not good. Having it less than 2:1 means then I will be facing liquidity problem in the future. So you can have a range of acceptable ratios. It's a very valid point. A is the right answer. B was the one. B, the range of target values, that makes B to be the correct option. The main difference between the current ratio and the quick ratio. Current ratio, quick ratio. Current ratio is current assets upon current liabilities. Quick ratio, also called the asset test ratio, it is current assets minus your stock or inventory minus your prepayments upon current liabilities. These are the differences. The differences are your stock and prepayment. So out of these, we have only been given inventory, so that makes B to be the correct option. Again, a bigger question, but we know what to do. Look at the requirement given and just simply do what is needed. So we need to find the current ratio, and current ratio means, and all this is given in percentages. Yes, now this is a little challenging one. This question will definitely take some time. We have been given vertical common size income statement and vertical common size balance sheet, right? What we need? Current ratio, current assets upon current liabilities. We need return on equity, that is net income, which is already given, but in percentages upon equity. All right. Current asset means I need cash, account receivables, and inventory. This is a good question. Yes, questions like these are challenging. That you can say that they will demand some extra effort compared to the question we have done previously. These percentages represent your current assets. Cash 4.8% of your total assets, account receivable 14.9, inventory 49.9. If you add these all percentages, your current assets represent 4.8 plus 14.9 plus 49.4. It gives you a total of 69.1. 69.1%. So your cash, account receivables, and stock is 69.1% of what? Of your total assets. What are the total assets? December 31st, 2007. Sales 2007 was 183 million. Sales 2007, this was for 2006. This is for 2007. At the end of 2006, Wells' total assets were this much. Equity was this much. At the end of year 2007, total assets were 95.93. That was what we're looking for, 95.3. These are your total assets at the end of year 2007. So means your current assets would be 69.1% of this. 95,300 times 69. It gives you 65,852,300. And what are the current liabilities? Current liabilities are 15 and 13, these two only. So the total of 15 plus 13.8, 28.8. So your current liabilities are 28.8% of your total liabilities and equity. Of course, total would be the same, 95.3 million. So 95.3 million times 28.8%, that is 27,446,400. At least this will give us current ratio. 65,85,2300 divided by the answer. 65,85,2300 divided by 27,446,400. It gives you 2.399. That's approximately 2.4. This one is little twisted. Net income is 5.2% of your sales for 2007. Sales for 2007 was 215.6 million. 215.6 million, and 5.2% of this is net income. So that gives you 11,211,200. The problem for you guys is you can't use the closing equity. We have been given the opening and closing equity, so we must take the average. That was the twist in this question. That is the twist. In 2007, equity was 48%. Of what? 48% of the total assets, which were 95.3 million. This was the equity in 2007. What was the equity last year? It has been given. Common equity was 37.8 million. So 37.8 million equity last year. Current year equity is 95.3 million, 48%. Add these all and divide it with 2, give you average equity. So it's 48% of 95.3 million. That is 45.744 million. To this add 37.8 million. You get the average up with 2. So the average equity is 41772000. Yes, this is a challenging one. A question that is taking more than average time. So 11,211,200 divided by 41,772,000. So it gives you 26.839%. That is 26.8%. So that makes C to be the correct option. So if you have analyzed the information carefully, extracted information and plugged in the right formula, you will surely get the right answer. So that makes C to be the correct option. 2.4 and 26.8. Next. Selected financial information gathered from Matador Corporation is as follows. We have been given the average debt, equity, return on asset, quick ratio, sales, cost of goods sold, what is needed. Using only the data presented, which of the following statement is most correct? Gross profit margin has improved. We will have to calculate. There is no way. We will have to calculate. Gross profit is the difference between sales and cost of sales divided by sales. So I'm going to calculate it directly this way. You can save your time as well. 1650 less 1345 divided by 1650 gives me 18.48%. 18.48%. 27. 1452 less 1176 GP upon 1452 gives me 19%. And 1304 sales minus cost of sales 1043. 261 GP upon 1304 times 100 gives me 20%. Please remember, this is the flow of the time. The flow of time is to the left. It means your GP has fallen and not improved. That makes A to be an incorrect option. GP is falling. Next, leverage. When we say leverage, that is debt upon equity. Debt upon equity in 2007 was 792 upon 215. It was 3.68. Then it was 800 upon 294, 2.72. And 820 upon 364, it was 2.25. What does it mean? How do we interpret leverage? Leverage can be interpreted in a very simple way. In 2005, it was 2.251. For every $1 of our own money, that is equity, we had $2.25 of debt. It was $1 was ours and $2.25 was debt. And it is continuously increasing. In 2007, for every $1 of equity, the debt is 3.68. It's much higher. Leverage has gone up. Incorrect option. Cross out. And if you want to guess, click C, move on. But we need to convince ourselves, and we need to discuss a very important derivation of a new formula. Return on equity has improved. We have been given return on assets. How we convert this return on assets into return on equity. So look at this interesting derivation of formula. Why I love CFA? Because it has a lot of maths, and maths has always been my favorite domain, a very strong domain indeed. So this is something that I feel quite excited about. Computations, manipulation of numbers, that's good. You will love it when you will be doing statistics. So we have to convert the return on assets into return into equity. Return of equity can be driven from return on assets. Through what? Let me show you. Return on equity is equal to return on assets. What are return on assets? That is net income upon average total assets. Right? What if I do average total assets upon equity? Average total asset upon equity, that is leverage. So it means return on equity can be calculated by ROE times equity leverage or equity multiplier. Do we have it here? We can calculate it this way as well. Let us just derive it further into another domain. Net income upon average total assets. Average total assets mean debt plus equity, right? Upon equity. Average total assets mean average debt plus average equity. Debt plus equity upon equity. So net income upon average total assets is equal to debt upon equity plus equity upon equity. Equity upon equity is just 1. Debt upon equity is what we have already calculated. The leverage. Debt upon equity we have just calculated. leverage. Now, what we know for sure that if we have return on assets, if we simply add 1 to this number, we can directly calculate our return on equity. Return on assets, 1 plus leverage, debt upon equity. I'm not talking about equity multiplier. Talking about leverage that we've just calculated, debt upon equity. So debt upon equity numbers we have already calculated above. What you will do, you will simply add 1 to it, 1 plus 3.68, 1 plus 3.68, and multiply this with your return on assets that are already given, 5.9. So that gives you 27.61. 27.61. Return on equity, a new column, return on equity for 2007 was 27.61. What about the last year? Debt to equity was 2.72. Simply add 1 to it and multiply the result with 6.6. It is 24.55. That's return on equity in 2006. What about 2005? 2.25, that is leverage, plus 1 multiplied with the return on assets, that's 7.2, gives you 23.4%. Now you are convinced that return on equity has increased from 23 to 27. So without doubt, C is the right answer. So this is how you overdo things to clarify and to enhance your understanding, playing with the numbers, the computations, all that. Question 54. Are the following statements about common size financial statements correct or incorrect? Let us see them one by one. Statement number 1. Expressing financial information in a common size format enables the analyst to make better comparison between two firms of similar sizes that operate in different industries. So far so good, but in the last part of the sentence he has totally reversed thing. In fact, common size financial statement analysis is used to compare different sized businesses in the same industry. I want to compare a smaller bank with a larger bank within the Pakistani banking environment. So I am considering about different sized bank operating within the banking industry. So it's different sized businesses in the same industry, not the other way around. That makes this option incorrect. Statement 2. Common size financial statements can be used to highlight the structural changes in the firm's operating results and financial conditions that have occurred over the time period. That's absolutely right. If your financial statements analyze horizontally from 2016 onwards to 2019, 20 and 21, you will see a pattern of your incomes and expenses, capital structure, current assets, current liabilities. This is true. Structural changes, operating results, financial conditions, the change over time can be seen through horizontal analysis. It's a correct statement. So the first one is incorrect, second is correct. So only one of these is correct. So that makes C to be the correct option. And C it should be. Using 365-day a year, a firm has a net annual sales of 250, average receivables 150. What is the average collection period? So very easy question. Average collection period is equal to the average receivables divided by your average annual sales multiplied by 365. Simple as that. You just have to apply formula. So you have a mixture of tough and easy questions. It's a mixture. 219.0. Perfect. C is the right answer. C it is. Again, many questions like these, maybe 4 to 5 questions like these we have done so far. So given the numbers, what are the average receivables collection period, average collection payable payment period, average inventory processing period? It's a simple division with 365. 365 5 by 10, 365 by 12, 365 by 8. You just have to simplify these and you will get your result. So 365, and that is 36.5. 365 upon 12, 30.41. And lastly, 365 upon 8, that is 45.625. So all these are 37, all these are 30, and out of these only one is 46. It means this is the combination of all correct results. So that makes B to be your correct option. And B it is. Next. An analyst gathered the following data about a company: current liabilities, total debt, working capital, capital expenditures are 250, total assets 2000, cash flow from operations 400. What do we need? If the company would like a current ratio of 2, current assets upon current liability 2, which of these options will help achieve this goal? First of all, let us see what is the current ratio right now. Current ratio is calculated by taking current assets upon current liabilities. We do not have current assets. Worry not. That's what you people are trained for. You need to calculate the current assets. Current assets aren't given. Working capital is given. Current liabilities is given. We know working capital is equal to current assets minus current liabilities. Working capital is 200. Current assets is unknown. Current liabilities is 300. So you can see the difference, $500. So we have current asset 500. So the ratio currently is of course not 2. It is less than 2. So which of these will help us achieve our goal? It says decrease current assets by 100. Decreasing current asset by 100 will not help because it will make the ratio 400 by 300. It's not 2:1. No help. Or increase current liabilities by 50. If you increase your current liabilities by 50, it will be 500 by 350, still not 2. Wrong. B. Increase current assets by 100. Yes, that will do. Increasing current assets by 100, 500 to 600, it will give you a very nice current ratio of 2. Or decrease current liabilities by 50. Decreasing current liabilities by 50 will give you 250. And yes, it works as well. 500 by 250. Yes, in both cases you get a current ratio of 2. Either 600 by 300 or 500 by 250. Look no further. B is the right answer. And B it is. And next, lots and lots of question of cash conversion cycle. And I'm sure you would have got the idea how to do. What is the cash conversion cycle? Cash conversion cycle is average collection period, average inventory processing period, or average period we hold on to inventory. And from this we simply deduct the average payable payment period, 274. And that's all. 95, 183 minus 274, it's 4. Positive. Yes, positive. But it can be negative. If it is negative, that's a great news for you people. For those who manage cash. Let's say I have a nice vendor who gives me a credit for 300 days. Look at this now. My inventory is held for 183 days. My customers take 95 days to pay. This is my operating cycle, 95, 183, 278. But my gentleman supplier gives me 300 days for the credit period. Resultantly, you know what happens? I have negative 22 days in my cash conversion cycle. Means my business cash needs are entirely run by my supplier, and I love him. It's because of him my business has no cash problems. See, it is possible to have a negative cash conversion cycle. That will be possible only if your supplier would give you an extended payment period, or you have an unusually smaller collection periods and inventory processing periods. So nonetheless, we got B to be the correct option. B it is. Next, RM Company's common size balance sheet shows current liabilities as a 20% of your total balance sheet number. This is a good question requiring some computations. Equity is 45% of your total balance sheet. 20% of your total balance sheet debt and equity. 45% of your total debt and equity. 45% of your total assets. This is already given. So the best approach to do a question like this is just to construct the balance sheet in numbers. Our total assets, this is your asset side, this is your debt and equity, called liabilities and equity. The total is $2,000. This is a very handy approach to find unknown numbers. This is the asset side. When you say asset, it means it could be the current asset or a long-lived asset. In the US, we call it long-lived assets or non-current assets or fixed assets. But this is the term used in the United States. Then on the equity and liability side, we have current liabilities, long-term liabilities, and equity. Now let's plug in the numbers. It says current assets are 45 of the total assets. That is 0.45 times 2000, that gives you 900. If this is 900, that means my long-lived assets will have to be 1100. Right? Now, equity is 45%. That means 45% of 2000 gives you 900. Current liabilities have been given 20% of 2000, that is 400. Now, what is long-term liabilities? Of course, the difference. The difference is 700. Now we have everything we need. Working capital is the difference between your current assets and current liabilities, right? $500, either A or B. And then debt to equity, this is your debt and this is your equity. 700 by 900. So 700 by 900 gives you 0.777, and that's rounded off to 0.78. Right, so that gives B to be the correct option. B it is. Again, a longer question, and let's see if just the requirement help us to find. We have two companies, company E and company G. The financial risk of E company as measured by the interest coverage. Let us calculate the interest coverage. Interest coverage, also called the times interest earned, it's equal to earning before interest and tax upon the interest expense. Let us calculate them both for E and G. For E, it's operating profit divided by 20. That is 30 by 20. For company G, it is 25 operating profit earning before interest and tax upon interest expense of 5. So 25 by 5, it's 5. So if you simplify, it's going to be 1.5, it's 5. Now it means that company G is in more comfortable position than company E. Now let's see what's the right option. The financial risk of E, interest coverage times interest earned, is a measure of financial risk. So the financial risk of company E as measured by interest coverage is lower than G. Yes, it is lower than G, and it's at least 3 times of G. No, it's not 3 times, because 3 times of 1.5 would be 1.5 times 3 means 4.5. It is not 3 times. Incorrect. The financial risk is not lower, the financial risk is higher. Why? Because your interest coverage is low. Having low interest coverage means higher leverage. That's an important point, higher risk. Option B, the financial risk of company E is higher than G, correct, because its interest coverage ratio is less, correct so far, than G, but at least 1/3 of G. Is it 1/3? 1.5. This is the interest coverage of G. 1/3 of this gives you 1.66. It is not at least. At least means it has to be lower than this. 5 by 1/3 gives you 1.66, whereas the interest coverage for E is 1.5, even lower than 1.66. That is incorrect also. Last option. Risk for company E is higher, yes, than company G, because its interest coverage ratio is less, yes, compared to 5 versus 1.5. And it is less than 1/3. Yes, it is less than 1/3. 1/3 is 1.66, and it is even lower than 1.66. Why? Because it is 1.5. So without doubt, C is the right answer. Question was easy. He was just trying to confuse you through wordings. C is the right answer. Question number 61. Pastel Company operates the following lines of business, which management believes have distinguishable return and risk characteristics. Distinguishable risk and return characteristic. It's an important point, must be marked and noted. Distinguishable return and risk characteristics than the rest of the business. This is the first condition that has been met as per the US GAAP. The second condition that is to be met is that the assets, nothing to do with revenue. The asset of the division that has distinguishable return and risk characteristics should be at least 10. Should be more than 10, but at least 10. 10% or more. 10% or more. This will be more specific. 10% or more of the total assets. What are the total assets? Total assets are 69,000, and 10% of this makes 6,900. So whichever division, gentlemen, whichever division has assets more than 6,900 will be considered as a segment. So which of these lines is Pestle required to report as a segment data? All of these are distinguishable with regard to return and risk, and any one of them which has more than 6,900 assets will be reported separately as a segment. So entertainment, lodging and services, all these have assets more than 10% of the total assets for the firm, so they must be reported separately as segments. So that makes A to be the correct option. A it is. Again, repetition of similar questions, but we are still staying strong. The data is given. We need the current ratio, quick ratio, and cash ratio. When you say current ratio, you will take your cash, you will take your stock, you will take your account receivables, plus you will take your short-term investments, 2,000, and divide them all with your current liability, that is 4 million. And please do not add account payable. This 2.5 million is already included in this current liability. Don't double count. Just 4 million or 4,000. I'm just omitting these 1,000 signs. So it's 2,000 plus 400 plus 1,200 plus 800 upon 4,000 gives me 1.1. Next, quick ratio. You simply need to exclude your inventory, 1.2 million. Rest of it is same. It's 2,000 plus 400 plus 800 divided by current liabilities. It's 0.8. And when you say cash ratio, for cash ratio, you need to remove your account receivables also. And account receivables are this. So you have just 400 plus 2,000 divided by 4,000. It gives you 0.6. See? So this, A, perfectly matching all the correct results. A it is. Speed and accuracy. And you can achieve this by practicing more and more. The traditional DuPont equation shows ROE, and we have done this many times. It's net profit percentage multiplied by the assets turnover multiplied by the equity multiplier. Net profit percentage, it's net income upon sales. Assets turnover, that is sales upon average total assets. An equity multiplier, that is average total assets upon average total equity. So where do we see these? Amongst these, first of all, this first one, EBIT, absolutely, we don't take EBIT, that's net income, wrong. This one is fine. Assets to equity, correct, but there is no 1 minus tax rate. There is no 1 minus tax rate, never. Net income upon assets. Assets are in denominator to some extent. Sales by equity, assets to sales. Apparently, the order is little missing, but let us see crossing them out. Sales crossed out. Assets crossed out. What we have is net income upon equity. I think this can work as well. Net income upon assets, sales upon equity, and assets upon sales. Sales cancel out, asset cancel out. So that should be the right answer. Net income upon equity. It makes sense. It should also be your return on equity. What about the last one? Net income upon sales, sales by assets, assets by equity. This one is giving us ROE again. That's our conventional formula. Net assets upon sales, sales upon assets, assets upon equity. Now, we have now two results that are giving us the same result. Now, if you have to decide, they are both giving us the same result. The simplification of this is ROE. The simplification of this is ROE. When you say traditional, the way it is laid out, this is the way it is laid out. Net profit into assets turnover into equity multiplier. This is the traditional way of, no doubt the result would be simplified to ROE, but the way we give it is this. So if you have to select between B and C, without doubt C is the right answer. Next. Very simple question. You just need gross profit percentage. Gross profit is what percentage of sale, and operating profit percentage. Operating profit is what percentage of sale. It's a joke, but let's joke around. 145 by 200 gives you 72.5%, and 115 upon 200 gives you 57.5. Fine, A is the result. Click A and move on. Next, comparing company's ratios with those of its competitors is best described as what? comparing companies' ratios with those of its competitors, competitor A, competitor B and C, and comparing our result with these is called cross-sectional analysis. Right? Ratios are being compared. Comparing companies' ratios with those of its competitor is best described as cross-sectional analysis. Common size analysis is also used to make comparison between your competitors in the same industry, but in this we have the whole financial statements expressed as percentages. So this is, technically speaking, is not ratio analysis. It is. Cross-section analysis involves ratios being compared, but here we compare financial statements versus financial statements that have been converted into common size, and this is a ridiculous term. So the correct option is A. Okay, now the next one, we have two statements and we have to see which of them is the right one. All right. What would be the impact on firm's return on assets of the following independent transactions, assuming that ROA is less than 1? This is a very good question requiring some serious thinking. Return on assets is less than 1. Right. Transaction 1. Attention, gentlemen. A firm owned investment securities that were classified as available for sale, and there was a recent decrease in the fair value of these securities. Amongst investment classification, those who have done CMA, I'm sure they know from financial statements, section A, available for sale debt investments, if their value increases over time, their fair value increases, this increase is not income. It is reported as a part of other comprehensive income, which is itself a part of equity. Available for sale security fair value gains, fair value losses are not your incomes and losses in profit and loss account. Rather, they are considered as a part of other comprehensive income, which is reported within equity. So if you ask me, sir, would this affect profit? Transaction 1, no, it will not affect profit. But would it affect return on assets? Yes, because return on assets is equal to your net income upon average total assets. Since your available for sale securities have decreased in fair value over the period, so assets have fallen, yes, and this decrease has been reported as a part of other comprehensive income. Nonetheless, assets have fallen, the denominator have fallen, so the ROA would increase. So this would cause the ratio to go up. All right. Then transaction 2, a firm owned investment securities that were classified as trading securities. Trading securities are those securities that have been held for the purpose of short-term purchase and sale. Any unrealized holding gain and loss, if the fair value goes up, it's considered as an earning in the current income statement. If the value falls, the loss is reported as a part of loss in the current income statement. Available for sale fair value up and down goes to OCI. Trading securities fair value up and down goes to income statement. Now we have a very interesting situation. Trading securities have increased in fair value, that would increase your net income. At the same time, your trading securities have increased in value, so they are both going up. Apparently you will say that numerator and denominator are increasing by the same amount, there won't be any change. You are damn wrong. Yesterday we discussed any ratio, current ratio, quick ratio, cash ratio, ROE, ROA, if it is less than 1, any number that is added to the numerator and denominator, it will cause the ratio to go up. Since the ROA was less than 1, we don't have the numbers. This was quite a handy tool that if the same number is added to the numerator and same to the denominator, it would cause the fraction, the ratio to go up because it is already less than 1. So it clearly said that ROA is less than 1. So adding same number to the numerator and denominator would cause the ratio go up. And why the same number? Because if your securities, trading securities increase in value, fair value is considered as a part of income, income goes up. Trading securities is a part of your investment, assets, assets go up. So your numerator and denominator are increasing by the same amount, so the ratio would go up, up, A. That makes A to be the correct option, higher, higher. Right, moving on to the next question. Apparently a big one, maybe you just have to do a very tiny bit of it. Receivables turnover. You can solve this question even with your closed eyes. Receivable turnover This is your account receivable. This is your sales. We don't need it in days. So in this case, what we do, we divide sales with your account receivable. 1500 upon 752 without even using your calculator. So that makes A to be the correct option, 2. Now, which of the following statements best describes vertical common size analysis and a horizontal common size analysis? Okay. When we say vertical, we take sales as our base in income statement and we move down. And when we take balance sheet, we take balance sheet total assets as our base and we move upward. This is called vertical. But when you say horizontal, we take a certain year as a base year and every number, every result after that is reported as a percentage of the base year. This is called horizontal. All right. Keeping this idea in our head, statement 1, each line item is expressed as a percentage of its base year. Statement 1 is pointing us whether towards horizontal or vertical common size analysis. So each line item is expressed as a percentage of its base year. This is horizontal. Statement 2, each line item of the income statement is expressed as a percentage of revenue, and each line item of the balance sheet is expressed as a percentage of total assets. Vertical. Third, each line item is expressed as a percentage of the prior year. No, this is the chain percentage, like we compare 2016 based upon 2015, then 2017 is compared with 2016 as a base. So this is not the vertical, or neither horizontal nor vertical. It's irrelevant. So what we can say now, the vertical one is statement 2 and the horizontal one is statement 1. So 2, 1, B it is. Next, we have been given certain information and we are required to calculate the after-tax return on equity. After-tax return on equity is after-tax. What do we need? Net profit percentage. What else? Assets turnover multiplied by the equity multiplier. Net profit percentage, do we have it? Yes. Earning after taxes. Do we have assets turnover? No, you can take sales and total assets. 300 by 1400. It's multiplication. Equity multiplier. For this we need average total assets, that are 1400 upon equity. We do not have equity, but we can calculate. Equity is 40% of 1400. 40% of 1400. So if you simplify all of these, which I'm going to do in one single go, 18% times 300 upon 1400 multiplied by 1400 divided by 0.40, again divided by 1400, it gives me 0.09642, which is approximately 9.6%. That makes B to be the correct option, and as you can see, B it is. Question 70. An analysis of the industry reveals that firms have been paying out 45% of their earnings in dividend. This is called the payout ratio. Assets turnover is 1.2. Assets to equity, called equity leverage or equity multiplier, is 1.1, and the profit margin rate. I'm sure you know what to do. What is the industry's projected growth rate? It is for the whole industry. Just like price earning multiple can be calculated for a single firm, and it can be calculated for the whole industry, and it can be calculated for the whole stock market. Yes, there was a point when I was in stock market about 10 years ago. At that time, Bombay Sensex index was operating at 30 times of earnings. PE was 30. At that time, we were a poor economy as always at 5 times. So the PE can be calculated for the whole stock market, for the whole industry. So here we are talking about industry point of view. Your payout ratio is 45%. We need to calculate the projected growth rate of the industry, that is the sustainable growth rate for the whole industry. So the dynamics stay the same, the formula stays the same. Sustainable growth rate for the whole of the industry, it's equal to return on equity multiplied by 1 minus dividend payout ratio. Do we have what we need? Yes, we have the dividend payout ratio. Dividend percentage 45%. We don't have ROE, but we have the contents available to calculate ROE. ROE can be calculated by multiplying your net profit percentage 8%, with your assets turnover 1.2, with the equity multiplier 1.1. Simple as that. So 8% times 1.2 times 1.1 gives you 10.56. 1 minus 45%, that is 10.56% multiplied by 55%, and there you go. 10.56 times 55 gives you 5.808, which is a very nice match with your option B. See, B it is. Next, what do we need? Current ratio. Wallah Azim, too easy at this level. Current ratio is current assets. Current assets are cash, account receivables, marketable securities, and this. Divided by current liabilities is your accounts payable and short-term debt. As simple as that. Right? So it's going to be 100 plus 750 plus 300 plus 850 divided by 430. That is 4.65. B it is. Next, an analyst has gathered the following information about a company. We have been given assets turnover, after tax, profit margin, financial leverage. We need return on equity. We have done a question 1,000 times. Profit percentage 10, asset multiplier 1.2, asset turnover, and then we have financial leverage 1.5. So it's 0.1, 10% times 1.2 times 1.5. It's 0.18 or 18%. B. Which of the following ratio is not a part of original DuPont system? Equity multiplier is, assets turnover is, debt to total assets, it is not. C is not. A company has a receivable turnover of 10, inventory turnover 5, payable turnover 12, company's cash conversion cycle. Wallah Azim. Repeatedly same things, but nonetheless nothing wrong with it. It will only refine your speed and accuracy. Don't take it negatively. Many students they don't practice much. They believe that reading books would be sufficient. They must suffer. They must suffer. And they do. 36.5, 365 upon 5 gives you 73, and deduct 365 upon 12, 30.42. So 36.5 plus 73 less 30.42 gives you 79.08, perfect match B. Now, something bigger. Johnson Corporation had the following financial results for the fiscal year 2004, right? What we are required to do? The only current assets are cash. We have been given current ratio. We have been given quick ratio. Did we miss any question? I think no, we didn't. So we have been given current ratio, quick ratio. We have been given current liabilities, inventory turnover, and gross profit percentage. The only current assets are cash, account receivables, and your stock. It's a good question. I would say a lovely question indeed. A lovely question. When I say a lovely question, you should keep the average of 4 minutes for that question. It will take time. The balance in these accounts has remained constant throughout the year. Johnson's net sales for the year were, we need to find net sales, and we have been given a plethora of information and we don't know what to do with this. So where to start from? Let us first analyze the question. It's a good question. I would say the question of the day. We have been given the gross profit. We need sales. So we can use gross profit to find sales, but we don't seem to have CGS. It means the first step from gross profit is to first calculate CGS, right? This CGS, once calculated, can be used with this percentage to convert sales. But CGS cannot directly be calculated because we have inventory turnover, right? Inventory turnover requires inventories. Do we have the inventories? Without inventory, we cannot find CGS. For inventory, we have to resort to current ratio because this is the one, current and quick ratio. The difference between these two is your inventory. So it's a flow of information. First, you need to find your inventory. This inventory will feed into your inventory turnover formula. This will give you CGS. And after you find your CGS, you get your sales. Amazing question. Wonderful question. So first you will have to find your closing stock, your inventory. So how do we do that? Something new coming your way. We know the difference between current ratio and quick ratio is because of closing stock or your inventory. So I can write it this way. This is the first step of the question. Current ratio minus quick ratio. Current ratio minus quick ratio is equal to 2 minus 1.25. This is something unconventional, but it is very handy for manipulate the formulas to get your desired result. Current ratio is current assets upon current liabilities. Quick ratio is quick assets upon current liabilities is equal to 2 minus 1.25, that is 0.75. Right? In other words, you can say you have the same denominator. It's current assets minus quick assets is equal to, and do we have current liabilities? Yes, 100,000. So it's going to be 0.75 times 100,000. It tells me that the difference between current assets and quick assets is $75,000. Right? And what is the difference between current assets and quick assets? It says the current assets are only cash, account receivables, and inventory. It means the difference between these two, cash, account receivables are in quick assets, cash, account receivables, and inventory are in current assets. This difference is your inventory. This difference is your inventory, 75,000. That is what we needed. That is the key piece of information. We have got our closing stock or in our inventory. We can use this in our inventory turnover to find CGS. We know inventory turnover is equal to CGS divided by your inventory, which is $75,000. Inventory turnover is 12. That means your CGS is 12 times 75,000. Gives you $900,000. That is your CGS. It is not over yet. Now let me give you a very helpful, handy tool which we have been using for the last, 100 years. It's a very handy tool. Please focus. This is something very helpful. PSC. That is an interplay between your profit, sales, and cost of sales. It says your gross profit percentage is 25%. If gross profit percentage is 25, your sales will have to be 100 because profit is based upon sales. If your sale is 100, your profit is 25. Let us write it just as a number rather than the percentage sign because it's a very helpful tool for interconversion between cost, sales, and profits, markup, and margins. Very helpful. 2500 cost must be then 75. If you're selling an item for 100, there's 25 profit, cost must be 75. Now, one very fine piece of information. Gentlemen, please do not throw it away. Many students at this level have confusion over this. What the difference between markup and margin? Markup and margin. If you take 25 by 100, this is called margin, which is given right here, 25 upon 100. Profit expressed as a percentage of sales. If you express profit as a percentage of cost, 25 upon 75, this is called markup. So look for the word markup, means profit as a percentage of cost. Margin, profit as a percentage of sale. We can use this arrangement to find any unknown. Now we have the cost of goods sold and we need to calculate sales. Right? The next step you will do is just make a cross, multiply X with 75 and multiply 100 with $900,000. And you will simply get what you need. 900 times 100 upon 75 will give you your desired result straight away. That is 1.2 million. Just a little twist. I would like to spend some time on it because this will help you a long way in doing or managing computations for markup margin. We got the result, B is the result. What if the question would have said, what if the question said that it's a markup percentage, 25%. When you say markup, it means your profit is 25, but this time the base is cost. Profit is 25 based upon cost. If profit is 25, cost is 100, selling price will have to be 125. In this case, if you need to find sales, things are now different. It's a very helpful tool, a very old time-tested tool, will help you do question like these very easily. So we got the result. B is the result. Let's move on. B is the right answer. Again, many times we've done question like this. There are more than 10 questions related to this, but nonetheless, I recommend them, do them all. 365 by 10 gives you account receivable collection period. 365 by 8 give you the average holding period you hold on to your stock, and 365 by 8 gives you, 365 by 12 gives you the average payment period to your supplier. So first it's going to be 36.5. Next one is going to be 45.62 days, and 365 divided by 12 gives you 30.41. So I think C matches nicely with all the options given. So it's C. And if you're required to calculate the cash conversion cycle, this plus this minus this, right? So that makes C to be the correct option. Average receivable collection period. Simple. For year is not mentioned, most probably 2004. Right. Most of you will make a mistake. I'll tell you what you will do. Most of you do, you know what you will do? You will take your account receivable, you divide it with your sales and multiply with 365, you will get a wrong answer. Because if you remember, average collection period is equal to average account receivable upon your sales multiplied by 365. So if you have been given 2003 sales, please don't forget to take the average, because this is the right way to do things. 600 plus 660 divided by 2 gives you 630. This is the numerator you should take. Sales now 3000 multiplied by 365. You get your answer. 630 by 3000 times 365. It's 76.65, which is 76.7 B. Which of the following item is not in the numerator of the quick ratio? Numerator of the quick ratio. When you say quick ratio, it means you're talking about cash, marketable securities, and account receivables. So receivables are there, cash is there, inventory is in there. B. B is the right answer. Moving on. Now, what we need to do with this question? Sustainable growth rate. Sustainable growth rate is equal to return on equity multiplied by 1 minus dividend payout ratio. So first we need to find return on equity. Do we have it here? There is a long way. You use DuPont model, or there is a quick way. You calculate ROE directly by this formula, net income upon equity. Finish. One step, you're done. So how do we do? Equity is given, it's 7 million. Net income, this is earning before interest and tax. From this, first deduct this tax, this interest and tax. Tax is 35%. That's important. So first you will need to find earning before tax, that is 2 million minus 900,000. This is called EBT, earning before tax, 1.1 million. It has to be taxed at the rate of 35%. Tax at the rate of 35%. After tax, what do I get? I get 715. What did I do? I simply multiplied 1.1 million with 65%. It will automatically remove the tax amount. So this is what I have in the numerator, 715 upon 7 million multiplied by 100 gives me equity, that is 10.21. 1 minus dividend payout ratio is 28. Now it's very simple. It's simply 10.21 multiplied by 72%. Simple. 72%, so that gives you 7.3542, that's C. Sustainable growth rate is C, 7.35. Next, assume that QTEL Incorporated is in the communication industry, which has an average receivable turnover ratio of 16. Average receivable turnover ratio 16 means your customers pay you on average after how many days divided by 16? They pay you after 22 days, 8.2 days, right? All right. What do we need? If Q tells receivable turnover is less than that of the industry, this is the industry average, 16 or 22.8. If Q tells, the question says which has an average receivable turnover of 16. If Q tells receivable turnover ratio is less than that of the industry, this one is the industry average, 16 times or 22.8 days. If for Q tells, if the receivable turnover is less than the industry average, then which of these would be the right one? Less than the industry average means you take more time than this is the industry average. Your customers pay you later than the industry. That only time is the 25. Because having 20 days, it means your customer pay you quickly. You have more, or what you can say, in accounts receivable turnover is higher. Accounts receivable turnover is much higher. Having lower in accounts receivable turnover, then 16 means your customers pay you late than the industry time. Industry timing is 22.8. For you, it's 25 days. The quick way to do it, rather than converting them into days, you can simply convert these into turnovers. How do we do it? 365 by 12, that is 30. Turnover is 30. 365 by 20, turnover is 18.25. And 365 by 25, the turnover is 14.6. Right? So this is the industry average. If your turnover is less than the industry, so less than the industry is only 14.6. So that again makes C to be the correct option. C it is. Question 81. Which ratio is used to measure company's internal liquidity? Total assets turnover is activity measure. Interest coverage is solvency measure. Current ratio, yes, this is the measure of liquidity. C. An analyst has generated the following information about companies' different ratios. Quick ratio is given, cash ratio is given. We have been given the marketable securities and cash. What exactly are we required to find out? What is their receivable balance? Okay, receivable balance. The same mechanism that we did previously. Your quick ratio, quick assets upon current liabilities, it is 0.25. Cash ratio, that is cash assets upon current liabilities, is equal to 0.20. If you convert it into an equation, quick assets is equal to 0.25 times of your current liabilities. And your cash assets, cash and marketable securities, is 0.2 times of your current liabilities. Considering this equation 1 and 2, please, I want you people to feel comfortable with mathematics. Dividing equation 1 with 2, give me QA upon cash is equal to 0.25 CL upon 0.20 CL. CL cancelled out. What we have now, current assets upon cash assets is equal to 0.25 by 0.20. That gives you 1.25. Now it tells me that quick assets are 1.25 times of your cash assets. And we have these, we can just simply plug in this. We have successfully eliminated current liability. We have them. We have marketable securities and cash. They represent your cash assets, cash and marketable securities. Now we can simply find what is required to be found out. We need receivable balance. Remember, quick assets is equal to cash assets plus receivables. Cash assets means cash and marketable securities. And they are equal to 1.25 times of cash assets. They have already been given. 2 plus 10, 12. 12 plus R is equal to 1.25 times 12 gives you 15. So if you need receivables, it's 15 minus 12. Here we go, 3. Maths and English. If you have grip over these three things, maths and English, you can rule the world. B. If the inventory turnover ratio is 7, what is the average number of days the inventory is in stock? Simple. Divide 365 with 7 and you get your result. 365 by 7, 52 days approximately. B. What do we need? Return on equity. Return on equity, and only 1 year balance sheet is given. So return, this is the return and this is your equity. Nothing else. We can't take average because only 1 year's balance sheet is given. So return is 150 and equity is 1620. 9.25%. That is 9.3. B. How would the collection of account receivable most likely affect the current and cash ratios? current and cash ratios. First of all, current ratio is current assets upon current liabilities. Cash ratio is cash plus marketable securities upon current liabilities. So when you convert your account receivables into cash, account receivables fall, but your cash goes up. Current assets stay the same, no effect. But when you collect cash, this would increase your cash ratio, so it would increase. B, no effect in increase, B. Alright, next. As of December 31st, Manhattan Corporation had a quick ratio of 2. Current assets 15 million, trade payable this, receivable this. How much were Manhattan's current liabilities? Okay. Let's plug in the numbers, take in this ratio. Quick ratio is given. Quick ratio is current assets minus inventory or your stock upon your current liabilities. And it's given as 2. Current assets have been given 15. Do we have stock? No. Do we have stock? No. Current assets, trade payables, receivables, no. Inventory is given. Yes, given 6. 15 minus 6 is given. Current liabilities is equal to 2. Make CL the subject of the equation. 15 minus 6, 9 upon 2. So current liabilities will be simply 4.5. You need to know how to manipulate the formulas. We were given quick ratio. Quick ratio is current assets minus stock, because current assets were given. So we use this ratio and directly shorted our work. So B is the right answer. If a company has a net profit margin 5, assets turnover 2.5, ROE is 18, what is the equity multiplier? Millions time. Return on equity is equal to net profit percentage, assets turnover multiplied by the equity multiplier. ROE is given as 18%, net profit percentage 5%, assets turnover is 2.5. You can find the equity multiplier. Keep this as the subject, take all to the other side, and you will get your result. So 18% divided by 5% divided by 2.5 gives you 1.44. That makes C to be the correct option, and C it should be. Okay. Total assets turnover and a return on equity. Assets turnover is equal to sales upon average total assets. We have been given the average total assets. Return on equity, that is your net income upon average total equity. We have them all. Sales is given as 5 million. Average assets 3.75 million. So 5 by 3.75 gives you 1.33. Return on equity, for that we need net income. And how do you calculate net income? Sales, or simply take EBIT, 800,000 less interest expense, less taxes, gives you a final answer of 384. That is your net income. So net income 384 divided by average equity 1850, and you get your answer. Return on equity. So 384 divided by 1850, and that's 20.75, 20.75% or 20.8. So 20.8 and 1.33 C. What is the company's equity if their return on equity is 12%, net income is 10 million? One-liner question, unusual but perfectly possible. Return on equity is given. Net income is given. We can calculate equity, simple. Return on equity 12%, net income 10 million, equity can be calculated. So equity is equal to 10 million divided by 12%. So 10 million by 12% gives you 83,333,333.333 and so on. So that makes A to be the correct option. A it is. Which of the following is least likely a routinely used operating profitability ratio? Sales upon total assets turnover. This is the assets, it's an activity measure. Gross profit to sales is gross profit percentage of profitability. This is not a profitability one. We need to find the one that is not a profitability measure, that is A. Which of the following ratios would not be used to evaluate how efficiently management is utilizing firm's assets? Gross profit percentage is a profitability measure. Payable turnover is an activity measure. Fixed asset turnover is activity. Both of these are activity. We need to find the one that is not an activity measure. Of course, A, profitability. An analyst has gathered the following information about a firm. We need to find the operating profit margin. What can you do with this? You have been given the earning before interest and tax. It is your operating profit. Operating profit 150 expressed as a percentage of net sales. It's 30%. 150 by 500, that makes 0.30 or 30% is correct answer. An analyst has gathered the following information about a company. Cost of goods sold 65% of sales. Inventory is this much. What is the value of the firm's average inventory processing period during 365 days a year? We just need to know the formula and you know what to do. What is the inventory turnover in days? That is your average inventory upon your CGS multiplied by 365. Do we have CGS? Yes, it's 65% of sales. That's 650. In the denominator, we have 650 times 365. Do we have average account receivables? Average inventory? Yes, it's given 450. Rest is simple. Simplification. See, 450 upon 650 times 365 is 252.69. Quite a long period, but this is what it is. Your inventory is held with you for about 252 days in a year. Right. Next, so that makes A to be the correct option. It is. So in this question, we just need to find the cash conversion cycle. We have already been given the receivable collection period 37, average inventory processing period 46, inventory holding on to the 46. So total 83 is the operating cycle. If from this we deduct 30, the average payable payment periods, you get your cash conversion cycle, that is 53, and 53 it is.